So, professors, we got to payment of expense. Payment of expense, and I want to specifically take my time on this one, because if you are not careful, you might miss the point. Okay, so you remember I told you about the extended version of the accounting equation and the impact expenses and income have on the accounting equation. So I remember saying that the normal equation we have is asset equals capital plus liabilities. However, the extended version is asset equals capital plus income minus expense. Okay. And the rationale is that if you are doing business, okay, your aim is to make profit. How do you determine or calculate the profit? You compare your income with your expenses. So for example, if I have a bookshop business, all I'm interested in is to sell the books and make profit. So when I sell the books, what I'm getting is the income, right? And the expenses could be maybe the rent I'm paying for the shop, electricity bills, I'm paying some salaries or workers, right? When you compare those two and you are making profit, that profit will add to your capital, would add up to the money you started the business with. Likewise, if you make losses, the losses are going to reduce your capital. That is why if a business continues to make losses, it ends up losing all its capital and has to shut down. Okay, and you hear most of our traders saying that the money they started the business with has, they normally say it in P, say, you get training in as in the capital has become zero because they continually make losses. Okay. So based on that, I concluded by saying if we analyze, then income in a way increases your capital and expenses reduce your capital. And this is because of the relationship they have with profit and how profit affects capital. So income increases profit. The more you get more income, the more your profit will increase. Hence, your capital will also increase. On the flip side, more expenses mean that your profit will be lower. Hence, your capital would also decrease. So please, when you see expenses and income in your transactions, the effect they have on your accounting equation will be on your capital, right? Okay. So let me continue now. So if we look at the payment of expense, so the expenses could be rent, it could be wages, it could be salaries, telephone bills, but a lot of them, right? I think we've discussed that in our previous list. So when you pay expenses, based on what I've said so far, the first effect will be decrease in capital. Decrease in capital, which comes in the form of that expense. Okay, so if the specific expense is given, rent, wages and salaries, telephone bills, then you caption that specific expense there. And that is what you are going to use to open your account, right? Now we make payment, or you can pay for your expenses using cash or check. So meaning that there will be decrease in asset, cash, or bank, okay? So anytime you make payment for an expense, the effects are that decrease in capital and decrease in asset, cash, or bank. So in terms of recording in the T account, you would have to open the expense account and your cash or bank account, depending on what was used to pay the expense. Now, what do you do to the expense account? There is a decrease in capital. And if capital decreases per the principle, what are we supposed to do, professors? Let me go back to that table. if capital decreases, we debit. So you are going to debit the expense and you credit the asset, cash or bank, because that is a decrease in asset, right? So anytime you make payment for expense, the effects are decrease in capital and decrease in asset. In terms of the two accounts you open to debit and credit, you open the expense account, you debit it, and you open your cash or bank account and credit it. Okay, so let me put a small example here. So on 20th May 2006, paid rent with cash, or paid rent 200 Ghana cedis with cash. Okay, so on 20th May 2006, paid rent 200 Ghana cedis with cash. So what it means is that we are paying an expense, but rent is an expense with cash. So dear professors, for the effect, you have decrease in capital, rent. So you put the name of the specific expense, rent, and decrease in asset, cash, since we paid with cash. In terms of opening the two accounts, then I'm saying that you open the rent account, which is the expense account. So you open rent account, which is the expense. And what are you supposed to do to that account? You are supposed to debit it, right? And you open your cash account and credit it. So let me demonstrate that for you to appreciate. So your cash. Okay. So in the rent account, we make a debit entry because that is a decrease in capital. So 20th May 2006, the narration will be the other account, which is cash. You put the amount 200 there. And in the cash account, same day, 20th May 2006, we put the details rent 200. So that is it for when you pay an expense. Okay. The other hand is when you receive income. So this time you are not paying an expense, you are receiving income. And like I told you from the onset, income increases capital. So if you are receiving income, your capital would increase. So for receipt of income, it leads to increase in capital and increase in asset, because the income you are receiving will come in the form of cash or bank, right? So professors, you can really appreciate that cash and bank are very popular in most of our transactions. So as we move forward, I'll tell you how you can master some of these things. Okay. So anytime you receive an income, there's increase in capital resulting from that income. So you use the name of the income given. It could be a commission received. It could be an interest on investment. You make an investment and you are getting interest on it, right? Okay. So in terms of the debit and credit, well, I'm sure you now appreciate it, right? So you open the income account. Since capital is increasing, you credit the income, because when capital increase, we credit. And then increase in asset, cash, or bank, you debit cash or bank. Okay. Let's go to the 9th one, which is drawings. And I think I explained drawings to you, professors. Please, who would tell me what drawings is in a business? Drawings. Okay, Prof. Portia.
Okay, so drawing is the withdrawal of a business equity for personal use.
Okay, so withdrawal of business resources for private use by the owner, right? So in terms of definition, you can say drawings refers to the value of resources taken by the owner of a business for his or her private use. So the essence is for private use. Okay. If he doesn't use it privately, but for business purposes, then that cannot be classified as drawings. So example, I'm a chop bar owner. If I take some of the fufu and I eat without paying the business, that is drawings, right? Because I'm supposed to pay. The fact that I'm the owner doesn't mean I can take the food and chop without paying. Likewise, if I give it to my friends or my family, and that is it, it's also drawings, right? Or I'm a car dealer and I dash out one of the cars to my wife. That will be drawings. Okay. Now, if it occurs, what entries are you supposed to make? Professors, drawings decrease capital. So decrease in capital and decrease in assets. Because remember, whatever the owner is going to take away would be a resource, an asset. It could be a land, it could be cash, it could be check, right? That's the bank, or it could even be the stock, the goods that we have. So there's always going to be decrease in assets and decrease in capital. Let me cite an example for you to appreciate. So I start a shoe business and I invested 5,000 Ghana cedis. So that is the capital for the business. And then the following month, I go and withdraw 1,000 Ghana cedis to celebrate my birthday. So it means that I've made drawings, right? I've used that 1,000 for my private use. So professors, you appreciate that. Number one, my capital will reduce because the business will now say, okay, owner, you don't have 5,000 with me, you have 4,000. So my capital would reduce. Correspondingly, the cash the business had would also reduce because the business initially had 5,000. But because of the drawings I made, the cash will reduce to 4,000. So anytime the business or the owner takes something for private use, the effects are a decrease in capital and decrease in asset. So that decrease in capital is resulting from drawings, right? So in terms of the account, you open drawings account and then the other corresponding account will be the asset. So if it is cash, if it is a building, but if it is stock, if the owner took stock, remember the stock was recorded in purchases account. Anytime we purchase stock, we record it in purchase account. So if the owner takes stock, then it's going to affect our purchases account. Please note this down because it's going to pop up in one of the topics where the owner takes stock for private use. Okay. So, well, I don't need to repeat the principle. Decrease in capital means we would debit drawings and then we'll credit the asset, right? Okay, which can be. So the asset can be cash, it can be bank, it can be a land, or it can be goods or stock. So that one would affect purchases. Okay. Please, any question on drawings before I move to the next, which is returning was finally return outwards. Okay.
No, please.
Great. So shall we look at return inwards and return outwards? I think the last time I explained these two concepts with you. So return inwards. Return inwards refers to the value of goods returned to a business by its customers, okay, or debtors. So when your debtors return goods to you, that's return inwards. Okay. So dear professors, look at the analysis. We sell tomatoes. We sell tomatoes to our customers, right? So because of that, our tomato stock will decrease. But now our customers are bringing it back to us. So the obvious first impact will be increase in assets, stock, because they are bringing back the goods, the stock. So there will be increase in that asset stock. However, the account you open for stock will be returned inwards account. So like I told you, we normally don't open stock account. If you are purchasing stock, you open purchases. If you are selling stock, you open sales account. Hence, if your customers are also returning stock back to you, you open return inwards account. The corresponding effect will be decrease in asset debtors. Okay, because these customers are returning, or these debtors are bringing back the goods to us. So how much they owe us or how much they were to pay us will decrease. That's why we have decrease in asset debtors. Let me cite an example so that you appreciate. I don't want you to be confused. So Omega Accounting Business, we sell pens. We sold, say 10,000 cedis worth of pens to students. Okay, so they didn't pay, so they became debtors, right? So they owed us. So our debtors were 10,000 Ghana cedis. So we made sales, and these are debtors, right? Now 2,000 of the pens were not working, or were not flowing, if I should say, or use that word. Okay, so they returned it back to us. So dear professors, you see that when the pens come back, they'll come and add to our stock. That's why we have increase in asset stock for that returning ones. But again, they will not continue to owe us 10,000 because they have returned 2,000. So those that have returned balance should be cancelled out, right? So anytime there's returning was there's decrease in the asset debtors. In terms of debit and credit, I think you can apply the principle. Increase in asset stock, but we open returning one's account. Professors, we are going to debit that account because an asset increase, we debit, we make a debit entry. Decrease in asset debtors, if asset decrease, you credit. So it means you are going to credit your debtors. So let me do a summary here for you. Anytime there's return inwards, you debit return inwards account, and then you credit the debtor. So if the name of the debtor is given, that's what you use for the account, but you credit that debtor. Okay. Not to waste time, the opposite of this return inwards is return outwards, right? So this time, return outwards refers to the value of goods a business returns to its suppliers or creditors. Suppliers or creditors, most important. Okay, so the example I gave, we sell pens, right? But then we buy the pens from Melcom or Yakofa from Melcom. So Melcom is our supplier. So if we bring the pens and there are issues and we return some back to Melcom, who is our supplier or creditor, then that is returned out to us. So dear professors, you appreciate that this time the stock is going out. So there will be decrease in asset stock. But again, the account we open is going to be returned outwards account. Now, as the stock is decreasing, there will also be a corresponding decrease in liability, which is the supplier or creditor. Because if we bought 50,000 worth of pens from Melcom on credit, so we're owing Melcom 50,000. If we return 5,000 back to Melcom, then we will no more owe Melcom 50,000. That liability is going to decrease to 45,000. That is why if there are return outwards, you have decrease in liability or decrease in the balance on the creditor. In terms of debit and credit, I think you all appreciate that. We are going to debit the creditor. Why? Because there is a decrease in liability. And when liabilities are decreasing, you debit. The corresponding credit entry will go into return outwards account. Return outwards account. Why are we doing that? Because there is a decrease in asset stock. And the account to record that is return outwards. Hence the credit, because the asset is decreasing. Any questions, professors, before I make summaries and conclusions on what we've done so far? Okay, so professors, the best strategy here is when you see the transaction, okay, Josephine, I'll come to you. When you see the transaction, try and analyze and see the effect, because if you see the effect, then you can easily apply the principle of when the asset is increasing, debit, when it's decreasing, credit. And for liabilities, capital, and income, when they increase, we credit, when they decrease, we debit. Okay, great. Josephine, please go ahead.
Sir, please, will you ever have a transaction whereby both of them you have to debit?
No, so that would violate the double entry principle. The double entry principle says when you debit one, there should be a corresponding credit, right? So you can't have a transaction that will lead to just debit. No, there's always going to be debit and credit, right? But you can have, you can have transactions where you do two debits in two different accounts and do one credit in another account, right? Let me give an example. So you see, these 11 transactions are the basic transactions I've taken you through. You might have some other transactions, but because you understand these 11, you can apply and get the debit and credit. Let me give an example on this. On the 1st of January 2025, Amma started business with cash of $100 and a building of $2,000. So look at this transaction well. Amma started business. So Amma is the owner, right? Started business with cash 100 and a building of 2,000. So I think you all agree this is investment by the owner. The owner is giving something to the business. what did the owner give? The owner gave cash and building. So we are going to acknowledge the capital, but the capital came in the form of what? Cash and building. So if you were to tell us about the effects, right? The effect will be increase in capital as well as what? Increase in assets. You have building and cash, right? So increase in another asset, cash. So you can have scenarios like that. Or better still, somebody doesn't want to confuse himself or herself. So you say increase in asset, building, and cash. Like this. Okay, but if you go the first way, where you separate everything, it is not wrong. If you are preparing the account, dear professors, you see that you'd have to open capital account, open building account, and also open what? Cash account. So you would have 3 accounts. But if you realize all the transactions we went with 11, we're opening 2 accounts. But this time you are opening, say, 3. But the double entry principle will not be wrong because let's do it together. Then you will appreciate. So let me get these accounts empty. Okay. So professors, you appreciate that you have to open capital account and also open the buildings account. Building and also open. I don't normally teach this, so I give to my students as tests, but today I'm teaching it. And cash, right? So look at what is going to happen. When capital increases, we credit, right? And when the asset increases, we debit. So this transaction is actually telling us to credit capital, okay, with 100 and 2,000 because the capital came in the form of 2 assets. So let me do that for us to see. So credit capital on the same date, 1st January 2025, but one of them is building, cash first, which was $100, and the other one on the same date, 1st January 2025, a building of say 2,000. So the corresponding entries will go into the cash and buildings account respectively. So in the buildings account, you debit 1st January 2025. The details will be capital 2,000, and in the cash account, the other debits will come. So 1st January 2025, capital 100. Now, dear professors, if you pay attention, the double entry principle says when you debit, you do a corresponding credit. Now, if we sum the total debits, the total debit will be 2,100, and it will be equal to the total credits we did. So that's the essence of the double entry principle. Your credits should always have a corresponding debit, and they should always be equal. If they are not equal, it means you haven't applied the principle properly or well. Okay, so you can have transactions where you have to even pass 4 entries or even 8. It doesn't matter. At the end of the day, your debits should have a corresponding credit and they should be equal. So Josephine, I hope you are comfortable.
Yes, please.
Okay. Any other questions, professors, before we zoom into the next or the last session? And this time, we will start recording transactions. Now, professors, let me also alert you on this. The 2 main requirements of this question, number 1 will be to show the effects on the accounting equation. Or in some books, you see show the effect on assets, capital, and liabilities. Okay, that is one of the requirements. If you see this as the requirement of the question, what you are supposed to do is to tell us increase in asset, decrease in liability, or whatever, as we have discussed. On the other hand, if you are asked to prepare the ledger account, or post to the ledgers, then professors, they are expecting you to draw your T account like we have been doing and do your debit and credit. So note the difference between the two. Because I've had students preparing the account when they have been asked to show the effect, right? So you prepare this T account when you see prepare the ledger account or prepare the account. Okay, or sometimes they say record the following transactions in the ledger account. So I believe that is clear. So Augustine, Oswald, Austin is here. Josephine, Portia, Eugenia, and Zoe. I believe you are okay and comfortable.
Yes, sir.
Okay. Yes. Okay. Good. Now, finally, if you are given the transaction, don't panic. Okay. Just like the way I've been using our daily life experiences to make it more meaningful. Try and do that. And you can be able to tell that, okay, in this transaction, there's an asset, there's a capital, there's a liability. Okay. Then you apply the principles. Well, I believe my professors will be very much comfortable with, what we have discussed so far. So professors, let's meet and see if we can solve this question, or I think I should take let's look at this one too. We might not be able to finish this one. So maybe we'll try the first one. Okay. The first question. And then maybe we'll discuss this one. And you might take it as an assignment. Now, my focus now will not be on the effect. My focus now will be on preparing the account. That's opening the T account to debit and credit. So let's meet in the last session and see how best we can deal with it. Okay. Bye for now.